those technologies are already, moving into the marketplace. So we have to be focused on innovations in order to continue to remain competitive and produce value for our investors that's better than our competitors, right?
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Scott Choppin. Scott, how are you doing today?
Todd, I'm doing great. Yeah, thanks for the invite. I'm glad to join you.
Yeah, definitely. I appreciate having you on. And a little bit about Scott. He is the founder of the Irvine-Pacific group of companies, a Long Beach, California-based real estate development company founded in 2000, focuses exclusively on urban infill and affordable housing communities throughout California and the Western U.S. Over the last 18 years, the company's developed nearly 1,700 units of unique to market urban housing community throughout the Western U.S. Currently, Urban Pacific has created a new housing innovation called UTH, which provides middle-income, multi-generational housing to urban families while producing market superior yields on invested equity. I'm going to let Scott explain more about that because that's a mouthful. So I'm going to let you kind of explain what you guys are doing, maybe a little bit about your background and fill us in on the details that I haven't covered so far.
Sure. Yeah, no, appreciate that introduction. So, as that introduction said, we're a real estate developer. So I see that being differentiated from an investor. For me, I always thought of those as, generally synonymous, but I'm in my, close to 40th year in this business. I've really come to the conclusion that they're very different offers, and that's great. I mean, they're both good offers, like you and I spoke about before. So, family background in real estate development. My family's been building and developing in Southern California since 1960. I came into the business in the mid 90s. Started work for a company called Kaufman and Broad Multi-Housing Group, which is a national home building company everybody now knows as KB Home. And there I worked for a division that syndicated and developed apartment projects, so new construction, ground up apartment deals. I was there for a number of years, leaving ultimately as their most senior project manager with generally profit and loss responsibility for the groups of deals that I worked on. I left there to go to a company called Sares-Regis Group in Orange County, another regional developer of apartment communities, and I was their land acquisition director on the multifamily market rate side. So again, ground up development of apartment assets. You'll see a continuing theme here. And then in 2000, I started Urban Pacific, and at the time, the idea of urban infill, and that's basically building new communities in already built out neighborhoods on underutilized or vacant parcels, was not a mainstream, direction that real estate developers took, but a couple of folks that I know, a guy named Bob Gardner at a company called Robert Charles Lesser, was very positive on the future growth of cities and particularly residential housing product in those already built out neighborhoods that would be attractive to future demographics. So I founded the company in 2000 to pursue that product type. And we've been doing that now. We'll be on our 20th year of operation next year. And so fast forward to today, we've built, probably close to 30 projects all of them urban infill, different food groups is the way I think of it, Todd. So I've done affordable housing, tax credit, new construction. We've done condo, high density, urban infill, but most importantly, we've done the vast majority of our projects have been basically market rate multifamily. And so about 2.5 years ago, we noted a flat spot in the market in Southern California. And what I mean by that is both lenders and equity at the time were sort of pulling back from the, high density, complex, studio and 1 bedroom mix type of apartment projects. And so that gave us the opportunity to, poke our heads up and start looking around at what was the marketplace generally, what was supply and demand characteristics. And it really brought home for us the fact that there was a lot of supply coming online. Now there's a lot of demand in Southern California. I'd say we're the most undersupplied marketplace in the United States, but nonetheless, we don't want to compete, where everybody else is competing if we can choose to do something different. And so that had us create this UTH model that you referenced in your introduction, and that stands for Urban Townhouse. And basically, Urban Townhouse is a purposely designed and built rental housing model that it builds at a townhouse density, about 25 to the acre. But most importantly, we're designed a unit type that provides a 5-bedroom, 4-bath, 3-story townhome model. And our demographic concentration is on working moderate income families in the same urban infill communities that we've always built, but really serving, this vast middle group of family groups that are larger, moderate income working families who don't have the opportunity to generally rent in new housing that will fit their lifestyle. In other words, if you have a large family group, 6 to 8 people, a studio, unit in a high-rise, new construction, apartment deal doesn't make any sense. You would never choose it, and the rents are very high. So UTH was created. We created it and designed it to be multi-generational, fit large family groups. And we're on our 5th, 6th, and 7th projects right now in that business plan. The first 4 were a demonstration phase, and then the rest of them so far are larger projects and what we're now calling our production phase.
Interesting. And so I'm trying to picture like where these would be when you say urban infill. Are they in the heart of the city? Are they within the suburbs? Like, where is something like this going to be?
Yeah, where is, that's a great question. So we're not in the central business district. Think high-rise financial district. We're not there. Land's too expensive, and densities are wanting to be higher in those marketplaces. We generally will focus on peripheral neighborhoods from the central business district. So in Southern California, we're building in a city called Fullerton, which is it's not suburban, but it's not the central core. And Orange County doesn't really have much in the way of central cores, anyways. But you get the point. We're 1 or 2 neighborhoods out from the central business district. We're usually in low and moderate income neighborhoods because that's where the family groups that we rent to, that demographic of large working families, that's where they live. And importantly, these projects are going to be close to job centers, but in neighborhoods that are going to generally be more affordable. We just then happen to deliver a new housing type to those neighborhoods where we're supplying these 5-bedroom, 4-bath units, which, in every neighborhood that we're building in now, either there's been 30 or 40-year gaps since new housing's produced. Fullerton, I think, is 40 plus years since a new project in that particular neighborhood. And then we're delivering these 5-bedroom units into a marketplace where these families already live. So we're just really creating a new product and introducing it into the market where these families already exist. And we've had, huge, positive reaction to the family groups that are renting our projects presently.
No, I might be wrong on this, but typically when there's a 40-year gap, 30-year gap, if in building, it's typically because building just financially doesn't make much sense anymore.
Agreed.
Or there's just no demand there. Maybe the population has gone down, whatever it is, but it financially just doesn't make sense. So what are you doing in order for it to financially make sense? Are you getting credits or anything like that?
Mhm.
Or how are you making it make sense?
Well, so I'll add a third way of thinking as to why there's no new housing. And it's a California story, and it's really an urban story. But in a lot of cities in California, we don't have appropriate zoning for a higher density product. So, as an example, you'll have vast areas of major cities in California that are zoned all R1. And for the most part, you will never build anything in an R1 zone. And so you're physically just unable to build a product that is financially feasible. So that does tie into that financial feasibility question, right?
Yeah.
So you're right there, but it's really enforced by zoning. And so what we're doing is we're going into neighborhoods that are basically sort of off the beaten path. These would be a lower income neighborhood in Fullerton, use that as an example, or in West Fullerton. It's a blue collar neighborhood, predominantly, older houses and older apartment projects, nothing newer than the 60s or 70s.
Yeah.
And zoned in a way that didn't allow anything higher density to go there. So if you were to do a 4 or 5 story podium project, you couldn't do it there, right? And that's generally what's working today. So we found this interesting, intersection of all the sites that we buy are already zoned correctly for our 3-story townhouse, 25 dwelling units to the acre product. We're just finding it in neighborhoods that have sort of been passed over because they're not the right income categories for a new housing type. There are other people in California that do 3-story, predominantly condo product, for sale. They won't go into these neighborhoods because the incomes of the neighborhood don't, support the housing prices that they need to sell at, and people wouldn't buy there, right? Even if they were going to import. So this is a sort of passed over low and moderate income neighborhood story. This is a zoning story. And then really for us, the secret of this model is that by producing these 5-bedroom units, we're able to generate rent in a different way than was done, previously. The way we call it, Todd, is it's a density of bedroom count, not necessarily a density of units. And so they achieve the same thing, but the zoning we can, fit into existing zoning a little more easily while producing more revenue per unit. So as an example, in Long Beach, where we're based, I'm looking at a site will allow a restricted number of units, right? Let's say it's a 30-unit project, but there's no restriction on how many bedrooms I can put in that. And so as long as I can comply with the setbacks and the footprint and the parking, particularly, is one of the constraints, then I'm unlimited on the number of bedrooms I can produce in that project, and therefore rents can be higher. So ultimately in our projects, that generates a higher whole dollar rent. Right now most of our projects are renting between $3,000 and $4,000 a month for a 1,750 square foot unit, which is, basically the size of a house. If you were to build something new, it is an attached apartment with a garage on the ground floor. But it fits in this, sort of missing middle income, middle density category, very nicely.
Interesting. I got a question. This is not really related to what we've been talking about so far, but I got to ask it because it's on my mind. California has this investor flight, I would say, is so many investors that I know that are from California, live in California, are not investing in California.
Right.
They want to invest
everywhere
else,
right? Everywhere else,
and it's funny because I invest both in Minnesota, where I live, and outside of Minnesota. And when I call brokers and I talk to them, I make sure I mention I'm not from California. Oh, good.
I'm definitely not from there, right? I love it.
They don't want to deal with California people.
Yeah.
But anyways, so my question is, you're in California, you're building in California, there's opportunity in California. Do you have an idea of why people are running from California and not investing there?
Yeah, I actually do. And as we spoke about earlier, value add is the most powerful, offer in the marketplace right now for investors to invest in multifamily product. It has a different risk profile than development, the existing assets already got occupancy and cash flow. And, for a lot of folks, that's invaluable, or they would never choose a deal that didn't have that. And I accept, right? But, we do the same thing when we buy existing. but we're focused on development. The reason people are leaving California is because it's become so expensive. I mean, we are, by different measures, the highest priced and most sought after multifamily marketplace in the United States for capital that may be overseas, or institutional capital sources that want to be in markets with exceptionally high demand and low supply, right? If you can get into the marketplace appropriately at a certain price, then the other characteristics of the market, undersupply and high demand, are very, powerful, attractive for us, right? But California investors, having either owned historically and watched the rise in price and are net sellers in that marketplace because they can get very high values. Then when you sell, you go, okay, now what do I do? I can't rebuy in California because I'm going to be buying at the price that I sold. That doesn't make sense. So then you start to look outside of California for, better cap rates, better per unit values, even if the rent and supply stories are different. And, we've done the same research ourselves. So I think it's just a very high value purchase market. Lack of deals, certainly lack of deals that are priced appropriately to be defensive, right? I mean, I think are all tracking it, but we're all of the mind that a recession's coming at some point. And to me, if you were going to go into an existing asset at a very, very high value, low cap rate, a very thin margin for any change in, economic cycle or interest rate changes, it's just it's a weak position to be in. And again, not saying value add is weak. I'm just saying overpriced value add is weak, right? And so our development model, allows people to, to buy into deals. And although our values are high also, we're raising capital on long-term hold basis that allows our investors to come into our deals buying in at maybe a 6 to a 7 cap rate. In other words, that's the value that we raise capital in or for when we, get done with the deal and rent it up. NOI to cost is 6 to 7, right, in a market that's easily 4 cap or sub 4 cap rate on a regular basis, even in very marginal neighborhoods. And so that's part of the reason our offer we think has value. But California is just it's a tough market, right? So high values, but if you can get in, restricted supply and high demand, right? So that's a good story, but it's got to make sense economically, as you'd expect.
Well, and maybe tough zoning now and permitting and all that kind of
Well,
stuff.
that's part of the undersupply story. Now, if that's part of the reason it's so expensive, right? There's just not enough new supply. So in any restricted supply situation, it's interesting, listening to the, political voices in California, both the, state and local governments who are like now under a mandate to produce more housing. But then when you find the neighborhoods where new housing's, wanting to be produced, like, oh no, we got enough, right? Like a NIMBY approach. And you go, well, no, because look at the economics, right? Restrict supply. And of course, equal demand or higher demand, and prices can only go up both in valuations and rents. So there's this weird dichotomy of thinking of, oh, let's restrict supply and therefore it'll make it more affordable. And, everybody's sort of forgetting their economic 101 lessons.
Yeah. So I got a couple questions that came out of there. First of all, are you guys keeping your assets long term, or is it a certain hold period?
We so in the early parts of the demonstration phase, we did those first 4 projects. Our intention was just to prove the model up. We wanted to be disciplined in our approach and make sure nobody's built at scale 5-bedroom 4-bath units. So we wanted to make sure it was a viable model, and we've done that. We've now completed the sale of the first 3 assets that we developed. But here's where we go with it. So 2 things drive us changing now to a long-term hold basically position in our capital raises, which long-term hold generally for us means 10 years plus. Okay. And I'm of the philosophy that if I can keep, as a company, hold on to them forever, that's where I want to be. So that's,
if you hold on to them for forever, quote unquote, right, forever, are you getting your investors out of those deals somehow, or are they always staying in?
Yeah, well, we're seeking people that would like to be in them forever, and so we have a few family offices that are oriented that way. But as you would expect, the marketplace generally is looking for fixed period of time to invest.
Yep.
Forever's too vague for people,
Forever's vague.
and rightly so. So we got to be coherent with that. So generally, we're setting a time period of 10 years.
Yep.
Of course, any capital raise has to have some provision for if an investor needs to exit for like emergency purposes or some other we'll give a certain percentage of redemption capability within the LLC structure, and then we are raising literally around a 10-year hold. But then we'll also put in mechanisms in the LLC agreements that, at 10 years, we say, hey, we want to hold, you guys will buy you out. So think of it like a put and call option. So it's a mechanical, legal characteristic of the LLC agreement that allows us to, produce a yield for them. Because at the end of the day, they're investing to make money. And, we need to hold that concern first and foremost, and we do. So we need to have a mechanism that allows us to create the value that they need, allow them to exit, but allow us to hold on to it. Now, could be that, they decide to stay in, great. We could both decide to sell in 10 years because the market's great. We've come through a recession. Part of the reason, Todd, we do 10 years is that, we're of the mind and we're vigilant about a recession coming. Right. I think everybody's, expecting it. Does it come in 12 months? Does it come in 2 years? It's unknown. But we've switched to a long-term hold model because we make the assessment that if we have a recession, anywhere from 2 to 4 years from now to start, and it's, 2 to 4 years long, then a 10-year hold period has some comfort level that we ride through the recession and come out the other side, and that we're not forced to sell in year 5 when we're in the depth of whatever downturn hits us. So that allows us to be patient because we all saw in 2008, 2009 that at least in California, a lot of the apartment projects that were transacting at that time were actually cash flowing very stably, right? No, reduction in any major way of rental rates, but values were off, right? Because the economy was off and cap rates and demand characteristics for purchase of apartments, disappeared for a period of time almost entirely. But if you looked at the income and the NOI, they were like really stable. And so if we, move that thinking forward, and particularly related to our stable tenant base of working families who tend to stick around because they have strong social networks, we're of the mind that we're going to have a relatively stable renter population, stable NOI, but we want to be defensive against valuation reductions, which, we interpret will come. But that, we've seen, 2008, 2009 values return, even, exceeding, those, pre-recession values to a great degree in some cases. We can't know that that will be the case for our projects in 10 years. But we know the undersupply story is not going away for probably decades, right? We're never going to catch up in any short-term period of time. And so, we look at this undersupply, defensive, stable, renter base and protective time periods to not have to sell in 5 years during a recession as our best chance to produce value in the 10th year for these investors when we exit.
Yeah. You talk about recession. Obviously, as you said, we don't know if it's coming in 12 months or 4 years. But doing development, you have an unoccupied building while you're in the development phase. You have a piece of dirt that you have before you even start the development phase. So you have some risk there. What Absolutely. Are you doing to hedge against that risk, to mitigate some of the risk factor that you have with the development? That maybe you wouldn't have if you just did a regular value add.
Right. Yeah, no, it's a great question. And so the first answer is what we just talked about of having, capital timing coherent with that, eventuality. Yeah. So that's the first one. Second is, the second two risks are a build out risk, meaning, what's our construction completion risk? And in fact, in a recessionary environment, I'm encouraged that construction costs may modify or moderate to some degree. I don't know that they'll go down, but at least the pressure ever upwards that we've been experiencing for the last, decade will slow down or plateau, right? So that's a little bit of a defensive mechanism. But the main thing is that we go, our biggest unknown is that we've finished the project, we have empty units, and now we need to go to lease, right?
Yeah.
And we're now in a recession. Like, that's the scenario I think about most. And so you have this market risk of, lease up. And then you could add a fourth one, which would be financing risk, which, you say you get to the end of the day and you can't find any permanent loan to take out the construction loan. So those are the last two. So on the rental risk, this is one of the interesting things. So our tenant base is very sticky. You heard me describe that before, and that's basically strong social networks. And so this is one of the protective mechanisms of this particular demographic, because differentiating from, like, say, a millennial or Gen Z renter, which is the predominance of new housing, is serving those demographics, and appropriately so, given how large that demographic cohort is. But millennials and Gen Z are much more mobile, right? If the job situation changes, their economy changes, and their jobs are lost, they can move home. I joke with our leasing staff that, those folks can move to Austin yesterday, right? And so that's coherent with their lifestyle, right? They're mobile, they're young, they don't have any, thing to tie them down. It's perfectly appropriate for their age group. But we just say, we don't want to rent to those folks. We want to rent to, to a demographic or a type of renter profile that is going to stick around. So that's our UTH, middle income working families. So their kids are in school locally, their church is down the road, their extended family is close by. And as importantly, that these families generally will choose their housing that's co-located to where they work. And in other words, these are not super commuter families that drive, 2 hours each way to live in Antelope Valley and, work in, the Basin in LA. They basically, so, one of our projects in Long Beach was, about 2 miles from the port of Long Beach. And our profile that, like our, renter avatar was a man who drove a truck at the port, right? Short haul trucking, was not going to commute in from a far distance, but would choose housing that, got him in and out of that, job location as close as possible. Plus, these families are, have multiple wage earners in the family. So our typical way we think of it is 6 to 8 people in the family group, 2 to 4 wage earners, say mom and dad, adult child, or 2, maybe, grandmother. We do build multi-generationally with a ground floor bedroom, bathroom. And so what we can look forward to is that we continue to offer units to families that are sticking around. So we're in a new, rental situation, empty units. So we have that, availability of tenant base that they're not leaving town generally, right? And so we can look forward to having, available families to rent these units. But here's an added benefit. We have found through our research that, in fact, our market rents are generally very close to Section 8 FMR rents. Because our units are so big, we are very close, maybe slightly above or below Section 8 FMR rents. And so I'll give you an example. We're looking at a project right now up in the Bay Area. We're thinking of renting these units at $4,500 a month for our same 5-bedroom unit, 1,750 square feet. And that Section 8 FMR is 4523. And so, at the end of the day, we wouldn't net 45. We have to take out the utility allowance. But in the defensive situation that we're describing here, down market, we would open up more of our units to Section 8 families, which, vast undersupply, in that market as well. Yeah. We don't intend to rent these 100% to Section 8 families. That's not our model. But we could certainly adjust that, very easily to expand into those marketplaces. So again, none of this is bulletproof. But what we do say is, we're looking at it, a downturn scenario. Does our underwriting and projections have the highest likelihood to succeed and be defensive in that environment? And everything that we do really is to, model and present a financial capital and renter structure that can make us defensive in that downturn scenario.
I like the answer. I mean, very good. And I can tell you have really thought it out. And that's what's really important when we're looking at a our investment strategy, and I don't care what part of the cycle you're in. I can tell you,
Mhm.
I've been in real estate for 11, almost 12 years,
Mhm.
and every year I've been into it, we're either entering a recession, going to see a double dip recession,
Mhm.
going to see interest rates skyrocket. We've got some sort of, sky is falling scenario that everybody
Right.
says, where if you prepare for and understand that we will shift, the market will shift,
Mhm.
there will eventually be a recession, and you have it well thought out, you're mitigating your risks. And that's
Right.
really all you can do is take those risk factors and go, okay, what are the checks that we
Mhm.
can put in place to kind of secure that, to really protect our investors' money. And you've done that, and it's really well thought out.
I appreciate that. The
Your
distinct,
strategy works for California. It works for where you're at, and it won't
right. Right.
necessarily work in, Minneapolis, but it works for where
Mhm.
you're at. And
Yeah. Yeah. The assessment we make is this, like we've underwritten, almost all the major urban metro markets on the West Coast and Denver. And then this model works in all those marketplaces, but absolutely in, middle America and even, parts of California that are inland, like Riverside County, just doesn't work. And, we're not like, upset by that. We just realize, our metric is when housing costs come down enough that rental houses, when people rent single family houses, those prices drop enough to intersect with the sector of the market that we want to be in, then that's a market we don't go in, right? And we can even sort of model it, from concentrically from the LA basin and get to, a few miles outside of the LA County border, and it stops working.
yeah,
So we're very, particular. In fact, I tell brokers, they send, the opposite I have with brokers. I go, I actually don't want the high end neighborhoods. I want the low and moderate income neighborhoods because land prices are more efficient and, zoning's a little easier to find, more available sites. But, again, that's where our demographic already lives.
well, then that's what I was going to say. And the two is you've got the demographic you've already caught onto. You understand them. You understand when they're moving, why they're
Mm-hmm.
moving, and
Mm-hmm.
that they're probably not going to move. A recession comes, these people want to cling on to their house.
That's right.
And the last thing they're going to do is try to move, because that's expensive for them, and
Well, I mean,
that might end
just
up being homeless if they.
right. Well, I mean, just the nature of, like just a basic fact of having kids in school is, I know for me, I have kids, they're, between 12 and 18 years old. I wouldn't dream of moving them. Now I'm, not necessarily am I comparable for this demographic, but I think all parents have that concern, right? So I go, if we understand it from that standpoint, then we say that's a factor that they consider. Just the same as when people buy homes, they want to be in the, the best possible school district. It's the same, sort of metric that they use. And just in this case, these families go, look, I want to be close to our jobs. And remember, it's multiple jobs, right? Mom and dad and adult kid and aunt and, Aunt Jane, they're all working different jobs and they need to be close to all those jobs, or at least as central as they can be. So that's a pretty powerful motivator to stick around.
Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments, hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com. Well, Scott, let's talk a little bit about the business and the
Mhm,
structure and things
mhm.
you guys have done to be successful. So maybe give us three key success tips that our listeners can take from you on what's worked well in your business. What have you guys
Mhm.
done really to move that needle forward to be able to get the 1,700 units built and
Right.
continue to establish a good business?
So one of the first ones I think just in thinking about this question, Todd, is it's something you said a little bit ago, which is sort of being protective about a downturn. Now, none of us can sit around like worrying about the sky going to fall tomorrow because then we'd never do business. So the mood I use, the description is I call it vigilant, right? I'm watchful, I'm prudent. We go continue to do business because we believe in the model and we believe in these marketplaces, but vigilance includes a certain amount of prudence, which is just being careful. And where that shows up is in underwriting. And in fact, I've been telling my teams as project managers, I basically teach them how to underwrite deals and run our pro formas and that kind of thing. Is that when I was younger and, both working corporately and, in the early years of running my own company, I was much more aggressive in how I assumed, the future would look on various things, rents, operating expenses, things we worry about in the multifamily business, costs of construction, which is
Right.
unique to development, and then, interest rates. And so I'm really, the joke I make is, when I was younger, every deal could work. Like there's no deal I looked at that I couldn't figure out a way to problem solve and be creative and make it work. And now I'm of the mind it's the opposite. Almost every deal is going to die, very quickly, as quickly as we can underwrite it and move past it. But I think it's just being oriented around a conservative underwriting. Now, I say that it sounds just like so obvious, but I think anybody who's new to the multifamily investment business and is hungry for deals, it affects how you look at your underwriting. And I think as somebody becomes more seasoned, including somebody like yourself, after a while you go, nope, can it, the broker says you can achieve a 200 a month rent increase if you, change the, interior specifications, and you go, maybe. And then you test and you go, no, it's really like 50 to 100. I'm making
Yeah.
these numbers up, of course,
Yeah.
but
Well, but that's,
you
yeah.
can make any pro forma work if you change enough of the right assumptions to,
Yeah.
to make it work. Right. I've done it, a million times. And so now I can, and I'll probably do this for the rest of my career. I just look at something, I go, nope, that doesn't work, and if that change in underwriting makes the deal die, then unfortunately that's what happens. And you just own that and move on to the next one. It's, there's plenty of deals in the marketplace and you should never be beholden to any particular deal so much that you're willing to, sort of, use weaker assumptions on your underwriting. So, call it powerful underwriting, conservative underwriting, however you want to describe it, but that would be in this business. And that applies to any deal business, right? Whether it be development or value add. So that's one. So the other one I really focus on a lot for my own career is continuous competitive learning. So I'm oriented around and work with a particular group that focuses on learning new and cutting edge strategic knowledge, right? So think of things that help us run our business more effectively. And I don't mean tactically. So, not how to do different accounting practices or what software to use. I don't mean that. What I'm meaning is ways to be in the marketplace, both as a company, like how we present to the marketplace, what our identity is, but also me personally as the person who is the CEO and founder of the company. So the strategic knowledge in this case are things about holding, building, and maintaining trust. Right now, everybody speaks trust in business. I think everybody uses it commonly, and there's nothing wrong with that. Right, it's a perfectly appropriate way to do it. But I'm oriented around how do you actually maintain and build trust, like truly, not BS. And so I personally spend a lot of time, and I work in networks of people who learn this continuously. And we're dealing with new technologies. In the development business, modular housing's a very new, hot and growing sector. 3D printed housing is an even newer technology, and those things are on their way. Those technologies are already, moving into the marketplace. So we have to be focused on innovations in order to continue to remain competitive and produce value for our investors that's better than our competitors, right? Ultimately, we're always competing. And I think it's just, the orientation around continuous learning, competitive learning practices to maintain that innovation, and that, new thinking. And then the last one is, as I look back, and when I founded Urban Pacific, I was 32 years old. And, if you look at statistically, that's when most people, start to get that, if they're going to be entrepreneurial, that's sort of the time in their life statistically that they decide to launch. And I don't know that there's anything magic about that. But as I look back on it now, I would really, if I was a new entrepreneur, I would think very seriously about even staying in the corporate world or whatever, job you're in, if it's appropriate for what you want to be, an entrepreneur for in the future, and really spend a lot of time on building networks. And networking is again, a term that people use a lot. And the way I think of it is not networking in the sense of going to a meeting and handing out cards, although that's one version of it, but really about building powerful networks of people who know you and you know them. You've built trust with them. You have an identity with them. Think capital sources, right, for multifamily investment or development. And so when you do eventually launch and say you do, instead of at 32, you do it at 37, that by the time you're 37, these capital sources have seen you in a more senior executive role, in a corporate role. They've watched you, do battle and problem solve and be creative, even probably seen some failures and some recovery from those failures. And so then when you launch, you have, a deeper and broader set of people that now believe in you. And so I think, it will make for a more powerful launch. I didn't do it that way. And I spent really the first, 5 to 10 years of my entrepreneurial career doing just that, getting no paycheck. I mean, we made, a lot of money during that time period, but I thought about how much more could I have made? How much further could I have grown if I had done it a little bit differently? And I don't I don't suffer over this, having done it different historically. I mean, I wouldn't trade it for a million. But I do go, is there a different, more powerful, strategic, effective, and competitive way to do it? And that's where I land is, building powerful networks as aggressively, as soon, and as powerfully as you can.
Yeah. I mean, I tell that to a lot of people. I mean, there's a lot of value in maintaining your job for a while. I mean, not only you have the steady income while you're building your business, but you're building those networks, especially. And it kind of depends on what type of job you were in. I was a teacher, high school teacher. So were my networks going to be that strong? No, but heck, could I do it?
But you could have kept the job and been intentional about trying to build networks in the real estate business, because that's where you change that, right?
Yeah, or I could have got a different type of job that would have allowed me to really learn some of the things that. Look, I mean, if you want to be an entrepreneur, you want to do this thing, you can be really intentional while you're at your job.
Absolutely.
Learning the processes and the systems, networking with people, building those relationships, getting throughout just not only your own company, but throughout the industry, and really learning and being intentional. And I mean, I quit teaching when I was maybe 27, and I struggled a lot early on with building those networks. I mean, that was a
same here.
big challenge.
Yeah, no, I agree. And, in fact, I wrote an article, if people want to go on our website, which I'll give to you later, but I wrote an article on 6 ways to build your real estate development career. And one of them was, get a mentor and do internships. Now, that's not necessarily a job per se in the way that we're talking about here, but the whole point of it was to get an education from people who already do it at the highest levels. And, in this instance, you could get a job as a, assistant PM or an analyst or whatever the job would be for, how to underwrite and put, multifamily deals together. And that is so much more valuable than, trying to do it on your own, or me do it on my own. And, you can read all the books. But, I've had mentoring relationships, and, I advise people, to continue to seek out and, again, mentors are a different form of network, but, back to that building networks thing, mentors are part of that. You can read every book. I mean, there's, podcasts like yours, and, there's tons and tons of info out there. And then I tell people, look, if you want to be a multifamily investor, go underwrite 100 deals to begin with. Don't even try to do the deals. I mean, if you find something that's so brilliantly underpriced, then, you'll find investors for it, right? But go underwrite 100, and knowing you're not going to do the deal, you'll know rents, you'll know your market, you'll have seen a bunch of product, the brokers, right? You've built your own pro forma. You've asked the brokers 10 million questions and figured all the right ones and wrong ones to ask, right? And, you get done with 100, and you'll be probably better than most, right? And that takes no money, takes time and energy. But you could do it no money, no risk, right? What a beautiful way to do it. And then when you come out and you do actually want to take some risk, now you're seasoned much more than most people do. I think people, like, you probably talk to those people as I have. Everybody wants to launch and get into their first deal as soon as they can. And I get it, right? The entrepreneurial drive and, wanting to make things happen is, usually, it's built into people. And I'm the same. But, you and I, having done this, a lot, you go, but there's a different, more powerful way to do it. So, hopefully people listen to these, your podcast and other podcasts, and, come out of that with, a more powerful way to start.
Yeah. And I don't think you're saying don't do it, don't get started yet, but you're saying, look, I mean, this is a long game, and we're in it for the long term. Be patient and do it.
Mm-hmm.
Educate yourself, get mentors, surround yourself with the right people, and do it the right way. You're going to be a lot more successful than if you just rush into it and think it's going to be a get rich quick type of thing.
Plus, I mean, the resources that are available today. I mean, when I started my, real estate, I mean, I knew I wanted to be a real estate entrepreneur at the time I was 18, which is a long time ago now. There was no YouTube, there were no podcasts. I mean, there was a few books around, which, I read everything I could. I took every real estate, course I could take in college. But at the end of the day, it comes from interpersonal relations with people, learning from deal makers, watching deals to happen. And so yes, it's more time. Yes, you have to be patient. I totally agree with your assessment there, by the way. But when you do your first deal, it will be so much better. And you can't know that, right? You can't know what a good deal and a bad deal is when you're new, right? Because you're new, right? Nothing wrong with that. But being oriented around, learning first and executing later. I mean, your first deal after you've learned and looked at 100 deals will make you probably 10 times the money you could have made had you launched, prematurely. And, or, hey, by the way, you missed the opportunity to lose a lot of money in the early deals, right? What's the saying of, observing others and learning from their mistakes, and not necessarily having to make those same mistakes yourself, right? Something along those lines.
Yeah, make mistakes on other people's backs.
Yeah. Right.
So with that, what's a mistake that you've made, and how have you learned from it, improved from it?
Yeah. So, the main one I go to, Todd, is just being mindful and observant and vigilant about economic cycles, and applying it to yourself, like literally saying I am not immune to the economic cycle. So the same philosophy that I described earlier, when I was young, I could make every deal work. Well, at the same time as, the recession won't, get me. And I didn't say those little words, but something to that effect. And in fact, a lot of the, social media, output and our mailing list output is about the tools that we're using to track the economic cycle, what our observations are, things that we saw in the 2008 recession that we might look for to be signs of the next recession. And the next one will be different. Even just having the knowledge of, every economic cycle is different. to not be, too listening to all the wrong people too much. Mainstream media is awful about, economic, tea leaf reading, economic,
Well, it's all about ratings for them. They
right. I
got
mean,
no, it's an agenda. I mean,
right. That's
just
right.
about how many people can watch their show.
That's right.
It's got
And
nothing to do with
so,
facts.
yeah, agreed. And in fact, what I've done is I have small, group of, channels that and I call them channels, but, blog posts, social media accounts, people on YouTube. So as an example, I follow a guy named Bill McBride who has a blog called Calculated Risk Blog. Look it up on Google, you can find it. And he's got a housing centric, view of the world. He's an ex, Fortune 500 executive, started writing about real estate and economic cycles and recessions prior to the 2008. In fact, made the call for the '08 recession, also made the call for, bottom of this, cycle in 2010, 2011. And great graphs. So he graphs lots of housing statistics so you can see visually, how we stack up today versus, past economic cycles. I also follow a website called EconPi, that's ECONPI.com. And they have something that how can I put it? It's an economic cycle tracker. And it's a grid system where they calculate multiple economic variables. And I don't remember the count, but it's something like 20 or 25 different economic variables. And then they graph them in a way that basically represents where we are in the economic cycle. Are we expanding? Are we contracting? Are we moving towards expansion, towards retraction? And gives a real time, basically weekly, twice, or every 2 weeks update. And that to me has been a very powerful way to look at it. We're tracking other, economic and recessionary indicators. Obviously, the yield curve has been, on everybody's mind lately, although people are suggesting that maybe because of, all the money that came in from the Fed in the last recession, that we maybe, have tweaked the cycle in a way that inverted yield curve isn't a good indicator anymore. But also looking for things like, oh, it's different this time, right? Remember, I don't know if you remember the internet bust in 99, 2000.
Yeah.
I remember people saying at the time, oh, it's different this time. Companies don't need to make money. Economic principles are suspended or something along those lines. And I really, at the time, I didn't listen to that because everybody was caught up in the frothiness of, everybody wanted to work for an internet company or own an internet stock. And then it all, came crashing down.
Reality
And,
hit.
and that should have been lessons learned for '08, but then, the internet's not real estate, real estate's not the internet. So it's different, right? I remember in 2006, there's a stat. In fact, I kept the article. I still have it in a book that I have all the clippings I made from, people talking about economic cycles. And it was, something to the effect of, again, a headline of, oh, housing prices have gone up, haven't gone down for like the last since 1930, and they had some graph that, I don't know how they made the graph work, but, you looked at it and you go, oh yeah, I could see that. And then you sort of buy into that, silliness. And, that's just one data point in a very, very noisy background. So now our jobs are to sort of like, read through everything that we, see and hear and, see on the internet and try to make an assessment about what is this person, what's their objective? Like you said, do they want to get ratings? Paul Krugman, is a well-known guy. He's been bearish for, somebody joked the last eight out of 5 recessions, he's been bearish, right? He's got an agenda. So I'm looking for people like Bill McBride, who writes Calculated Risk. He's got no dog in the hunt. He's retired. He's made his money. He has a skill set to read, statistics and read reports and report it, neutrally, right? He's got no like agenda. I mean, he's got a blog that probably, serves him well to generate revenues and retirement. But you can just, I've been following him for several years, and I just know from how he's approached things and watching him be successful in his assessments to know, okay, he's, he's a neutral. He wants to present what's the truth, at least as he sees it from his standpoint, and has no other agenda that I can tell. Now, I won't only rely on him. I want, at least 3 to 5 good, different, sector economic cycle, opinions or economic cycle tracking tools like the EconPy website. And then, at the end of the day, we all have to make our own assessment as to whether, a recession is coming. And even then, you don't know what the timing is. The yield curve was inverted, a few months back. People assess 12 to 18 months generally, historically, for the recession to hit after the yield curve inverted. But the 2-year and the 3-month, one inverted, one did not. That has never happened before. So clearly we're in a different, era for yield curve, but nonetheless, it's just, one signal amongst multiple that we have to track. And then you pair that up with the conservative underwriting that we talked about before. I mean, that's all you can do, is just try to have deals that are relatively defensive, that if a recession comes, you're not crushed. You may have to, manage it closely for, several years so you don't lose money, right? But you're not wiped out, which is, what we saw, a lot of people got wiped out in the '08 recession.
Is your philosophy to pull back when you see a recession coming, or is it to just continue on because what you've put in place is sound and you want to continue to grow?
Yeah, so that's a great question. I think that if you talk to most investors, they would say, and you'll see a lot of people that just go, look, I stopped building. They just, they don't do any more new projects. And that's certainly one way to do it. For us, if we were only a merchant build model, which is build it, rent it, sell it immediately, then absolutely, that's the thing to do. Is you just, as soon as you think there's any inkling, you don't do any more new projects, right?
Yeah.
Here's the interesting thing that I found, and again, being very cautious and vigilant about the cycle, is I'm actually encouraged by these long-term hold models that we're now in for capital raises, because if I can say there's a story around being defensive in a downturn, and I can have a model that's relatively stable, and I say relatively because, again, there's no guarantee. We don't sit here saying we're bulletproof and gosh, we got this, dialed and we'll never, have a bad day. We're just, again, saying statistically we have the best chance to survive and recover quickly, right? But actually, we're looking forward to construction costs moderating, like I talked about before. Looking forward to land becoming potentially more inexpensive, although in my experience, land sellers are always the first to jump on an upward trend and last to jump off of a downward trend. Capital will moderate. Interest rates will moderate. So we have to be cautious. I wouldn't go out and start 30 projects tomorrow, but I would start 3 to 5, and in fact we are starting that many, where we have a story that if it does change, that we can be defensive, and that's that's the way to be prudent, which is take a risk but having it well researched and conservatively underwritten.
Yeah, good answer. All right, so we got to wrap up here. I got a couple last questions for you. What's a book that you recommend to our listeners? Real estate, business, mindset. What's one of your favorite books?
So it's a great question. I won't necessarily quote any real estate books because I think those are pretty commonly known. So I go out of the real estate domain a little bit. So I'm a follower of a guy named Grant Cardone, which, you've heard about Grant. I love his 10X rule book. I think in this business of real estate, we're always trying to balance, going crazy and doing too much. But I also find that if I look at myself over the years, assuming I, now prudently underwrite deals, that I need to be setting my goals for the long run much higher than I have. And in fact, I'm in that process doing that right now. The other one we've been spending a lot of time right now. So we're actually building out a whole investor acquisition system, or what we call IAS. And that would be a platform that we have, website, email marketing, social media channels. And we do a lot of that work, but this would all be cohesively designed to get our name and identity and product type out in the marketplace as broadly as possible. And so that has us basically really spending a lot of time in the marketing domain and digital content production. If anybody goes and searches me on Google, you'll see a lot of our channels, Twitter and Instagram and LinkedIn. We're pretty broadly out there in the marketplace. But Gary Vaynerchuk is a guy I follow as well, and he has a book called Crushing It, or really any of his books. But his philosophy is the one I think about in answering this question, which he basically says, in this day and age of the internet and technology and digital content marketing, and this is applicable to any business, even the stodgy old real estate business, is that every company is now a media company and needs to be in the marketplace to do their business effectively and competitively, right? As a real estate investor or a real estate sponsor, you now need to be out in the marketplace like a media company is and would be, in a way to remain competitive, because all your competitors, both the sponsors or investors, are doing the same thing. So now we're a developer, sponsor, so we're out in the marketplace in that format, raising capital from investors. But the whole crowdfunding domain, a lot, I see family offices getting into digital content marketing to get their names out there. I had a phone call yesterday with a group who basically isn't a crowdfunding platform, but they've built a whole digital content marketing platform to raise capital for their business, which is like a fund manager intermediary. And then they talk to us as potentially putting that capital into our deals. And so everybody's making that move, and to remain competitive, if you're in that space, you got to continue to make that move. I would also say, for anybody who's trying to get, is in the space of trying to find more deals, be it land, be it deals to acquire as value add, you need to be doing that there also, right? I mean, what a powerful, mechanism that if you want to try to find as many off-market deals as you can, that's our mandate, both as developers and acquirers of value add deals. Why would you not be doing that? In fact, I assess that if you're not doing that, you're already behind from a competitive standpoint.
Interesting. Yeah. Good points there.
Thank you.
So last question before we wrap up, what are your 3 pillars of wealth creation?
So I'm gonna go back a little bit to what I talked about before about strategic knowledge, but basically, continuous learning, competitive learning. And what I say competitive learning is learning about new things, new technologies, new ways to do business better than your competitors, right? In whatever way that means in your industry. So seek out, people who are performing at the highest levels in any domain, but obviously we're talking about real estate, but even this digital content marketing world that we talked about, is seek out those high performers and learn with them, become part of their networks in a learning capacity, right? So acquisition of strategic knowledge is my main pillar for that. The second one we talked about before is building powerful networks. I continue to come back time and time again, Todd, I'm sure you find the same thing, that, I met that new person, I met that new company, and all of a sudden they expand my capacity and capabilities to do more deals, bigger deals, do deals more profitably. And I one day, I think I will get over this, but I'm just continuously surprised. I go, oh, that was so great to meet that new person and have them be part of my network. They're the right person. They're powerful in their own way and their own offer. They're after learning themselves. And then, transacting with them. And I don't mean like in a mercenary way, but trading, hey, let me help you. And I could use this help in return. That could be capital, that could be networks, that could be resume, that could be resources, deals, right? And in fact, my oldest son is a freshman at USC, and I'm basically coaching him. I said, look, you're going to a great school and that has a network. That's part of the reason we picked it. But you have to work and build your network in that school. Like you can't, not do that.
It doesn't come to you.
It doesn't, right? I mean, even at a place like that and in any environment, you have to be intentional and have that be your objective, and not just build any network, but build a powerful network, right? Like, if you have the top 5, most, valuable people in the world in your network, the Warren Buffetts and the Bill Gates and the Elon Musk of the world, and you had those people in your network, what level could you perform at? I mean, it would just be mind blowing. Some of us, none of us may ever meet those people in the way that I described, but if you go just a few notches above you where you're at, or several 10 notches above you, I mean, that's the people you need to connect with and learn from, and they will, it's be like rocket fuel. And then at the end of the day, I think both these strategic knowledge and powerful networks ultimately end up helping you to build powerful teams, powerful business organizations, right? And again, that's networks, right? So I have a group of people around me, vendors, architects, people who operate in the construction world, property managers, brokers, capital sources, people that I JV deals with, right? If we want to, trade risk in a deal, landowners. So all these people, as you build into a powerful business organization, becomes, sort of a flywheel of, benefit and positive growth. And then, so I think, the three pillars even work together. First you get the knowledge, then you build the networks, then you build the powerful business organization. And in fact, they sort of go in that order, the way I think of it. And at the end of the day, I mean, people assess you in the real estate business. I mean, even stuff as silly as like, hey, what kind of office space do you have? Or do you not have office space? And I'm not saying there's a right or the wrong answer, but if you want to be the most powerful operator, sponsor, or investor in the marketplace, and these are the sorts of things that you got to think about. And, any one of these three can help that. But when you put them all together, they become, much more effective and strategic way to operate.
Yeah. Good stuff, Scott. I really appreciate it. The time you've been able to spend with us. I mean, learned a lot, took a lot from this episode, and really just the thought that you put into your business and the answers that you've given have really provided our listeners a lot of value. Last thing I got to ask from you is, how can our listeners get in contact with you?
Yeah, appreciate that. So best way is to go to our website, which is www.irvine-pacific.com. There's a contact box at the bottom of our website, and we monitor that continuously. Anybody is welcome to email me. It's my last name, Choppin, at irvinepacific.com is the email. And, I keep that open. I'm on social media. So if somebody wants to send me direct messages on Twitter or Instagram or LinkedIn I use, quite a bit. So those are all good channels. And I have a team of people who monitor them, and, I'm looking at them almost daily myself. So those are great ways to reach out.
Awesome. Well, Scott, you have a fantastic rest of the day.
All right, Todd. Thank you.
Appreciate the time.
Yeah, likewise.
Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.